In today's video, I'm going to show you 3 technical indicators that every trader, both new and advanced, should know before they start trading. If you're someone interested in indicators, this is a video just for you. Let's get started. The first thing you need to know is that indicators are essentially a tool that can be applied to charts to give us some sort of reading or indication, for lack of a better word, about what the market may be ready to do next. There are a lot of different indicators. If you're looking at TradingView, you can go into your indicators section. You can see there are so many different ones that are available out there. But in today's video, I'm going to talk about 3 specific ones that I think are best for newer traders, starting with our very first one, which is going to be the relative strength index. Now, the relative strength index, when we add it to our chart, is going to create this kind of oscillator chart thing at the bottom of the screen. And don't worry, I'm going to explain first how this indicator works, and then we're going to talk a little bit about how you could actually trade it. So the RSI, if we zoom in just a little bit here, so the RSI is kind of an interesting tool. What it would actually do is if we just double click on the screen here for a second, you can actually see that the RSI has some inputs. Now, what you should know about the RSI is it stands for the relative strength index. And what it's going to do is it's going to give us a reading from 100 to 0 as to how strong or overbought or oversold a particular market is. So when we look at the USD CAD, which is what we're looking at right now, the US dollar against the Canadian dollar, what you're going to notice is that when this market starts to rise dramatically, the RSI starts to rise with it. And when this market tends to fall down, you actually see the RSI comes down with it as well. What this is doing is it's basically comparing a set number of bars back. It's reading a number of bars back to see how strong price is currently moving relative to that time. I know that was a bit confusing, but let me try and analyze this with an example. So if we take a look at for example, a 10-period RSI, what that means is it's going to take a look at the last 10 bars or the last 10 candles to decipher the relative strength where price currently is sitting. So we analyze, for example, a 10-bar RSI, and you take a look at this example right here, what you'll notice is that at this point, the market was identified as overbought. Well, what does that mean? Well, generally speaking, by the basic rules of an RSI, the 70 above a 70 is considered an overbought reading, meaning the market has gone up by a significant amount, is now being considered overbought, and vice versa. The green or the lower end, which you can change this on TradingView how you'd like, at 30 or below is considered a oversold reading. And the idea behind this is that when markets reach an overbought or oversold reading, there is a potential for them to reverse and sort of normalize back in the other direction. So in a couple examples here, you can see that we hit an overbought status around here. Now, this is not a perfect example of a topping point, but then you get this example, right? And what I should say very quickly is that indicators by themselves are not going to give you the end-all be-all answer to what the market's going to do. What they will do, however, is they'll give you insight and some ideas to think about when making your trading decisions. So for example, I actually like a shorter period RSI. And the reason I like this is just it's sort of personal preference, but also for my style of trading tends to work better. I like this speedier RSI. You can see it shooting back and forth. But if we actually just take a look, for example, and we zoom into an example, we can actually press the replay function here on TradingView to kind of test this concept. And right here, you can start to see that we've hit up into a overbought reading. Again, we can go down, take a look. We're reading around 75 to 90 in our range of what this reading is printing. And that is telling us that the RSI is telling us, well, this market is relatively overbought, right? Meaning that it has gone up by a good margin and there's a likelihood that it could come back the other direction. Again, there is nothing magical about the RSI. It's not going to give you the, secret and end all be all answer that's going to be needed, but you can see it does offer some insight. You can see here is an oversold reading that also formed right at a support level, which is another topic for another day, but you had a support level combined with the RSI. And this is where we start forming the early basis for technical analysis. We're looking for technical indications where price could go next and combining them with several other technical indications that where price could go next and trying to formulate a probability-based decision as to where the market could go next. From there, Here's another example. We're reaching oversold status, and let's see if we can get some sort of a bounce. You can see there's a bounce there. So now we're starting to top up. So this is the idea. So how would you trade this? Well, we would take this into account when we're doing our analysis. The indicator allows us to take, this factor, this additional piece of information into account when we start placing our trades and we start thinking whether or not a market is overbought or oversold. For example, maybe when price starts to top up here and starts showing us an overbought reading, maybe I'm shifting more towards selling, or if I have a buy position, considering closing my position, because we have now reached a status in the market where markets seem a bit stretched to one direction. That's just one example of our first indicator, which is the relative strength index, which is available on most charting platforms, things like MetaTrader, NinjaTrader, and TradingView, and actually almost all charting platforms have the ability to take a look at the RSI. Technical indicators are great, but there are many of them and many more that we can do in just this video. So I just want to cut in here and let you know that if you'd like a copy of our free technical analysis hand guide, you can get access to it for 100% free. All you got to do is shoot us a message on Telegram and we'll send you a copy. Just send the word technical handbook to our team. One of us will send you a copy of the PDF 100% free, and you'll get access to that as soon as you send us a message. Okay, so the next example of an indicator to check out, at least a beginner indicator, I think is the age-old example, the moving average. This is the simplest indicator probably on our list, and probably the first one that you've ever heard of when you think about charting and using technical analysis in your trading. Now, the moving average is exactly what it sounds like. It is a rolling or moving average of price in a X number of bars. So for example, we've got a couple different moving averages that we can apply on the screen right away. And you can see they actually have different natures. Some of them are faster. They move quicker, they change directions quicker, and some of them are slower, and they both serve their equal purposes. So we'll take a look at both. Let's start with a slower moving average. So if I actually just take a look at this red one, I have it marked, and let's say I just go, this is, by the way, you just go to your indicators on TradingView, go to your technical, and you can just scroll down and look for moving average. So looking at the moving average, we can take a look at the factors that go into a moving average. Clicking this gear, you got the settings. You can change the length of a moving average. And this length feature, this length field, is basically going to say how far back this moving average is going to look to compute a moving average. Now, when I say compute, what it's going to do is, let's say, for example, right here, it's going to go back 100 bars and produce a rolling average to analyze the chart with. So the reason that this matters is that a moving average can give you a smoothened approach or a smooth look at what price is currently doing. So a slower moving average, one that looks back further, is going to give you more data filtered in and usually is going to be a little bit smoother in its transition. Whereas a faster moving average, we'll put on the 20-period moving average, it's only using the past 20 bars and it will switch directions quicker. So again, you can see we're starting to see a reversal here, and in this case you do see the faster moving average adapting to the trend faster. So you may say, Nick, well, why not just use the faster moving average if it's just following price? Isn't that just better than the slower? Well, again, each one has its purpose. The slower moving average doesn't get tricked out per se as easily. So let's see if we can find an example of that. So here it is an example. We have an upward trend, right? See how this moving average is just trending higher and higher and higher? Well, look at the slow one was correct in this case, right? It continued to predict a bullish trend based on the trend that it's looking at. Whereas this moving average started to print a bearish market trend. And so the point here is that the fast moving average can sometimes be a very sensitive moving average, and the slow moving average can be more of a steady eddy, slow and kind of a gradual trend. So the point is, not one is better than the other. One is more adaptive, one is more sort of conservative with its trend prediction. The idea here is using both can actually be very valuable, and maybe even adding in a middle ground or incorporating a third party or a middle tier of speed. So the point here with a moving average, the way I will use it in my trading is I'll use them as added filters. I do like to trade with the trend. You may have heard that statement over and over in markets: trade with the trend is your friend. trends can often be identified by simple moving averages. There's nothing major about them. There's no magic here with this moving average, but it can help us to identify clean trends. And what you'll notice is that when this market starts to agree, or all three moving averages start to point in the same direction, that can be a powerful indication as to the trend. So in this case, you can see we have a very strong downward trend. So in this environment, you may take this into account and look only for sell trades. In fact, let's take a look at what we were printing before. We were talking about the RSI. Perhaps we decide that we want to build a simple trend following strategy, incorporating the two indicators that we've identified so far. Step one, we've got an RSI. Step two, we've got the moving averages. And let's say that we're waiting for a downward trend to develop on the trend lines, the moving averages, and then we're looking for an RSI that prints overbought. So for example, we have starting here a strong downward trend. We're looking for an overbought status. Here's one right here, and we sure enough have a sell signal that looked pretty good. Here's another overbought reading, and you could see a nice sell signal was produced. Here you could argue that this one is one, but it's a little bit close, but you can see there was a beautiful sell signal there. So what you're seeing here is the formation of a simple trend following strategy using a combination of two indicators, moving averages and relative strength index. Again, this is just a very simple concept that the market is producing. It signals, and you can see it's not a 100% win rate. Now here's some examples of some overbought readings coming in, and sure enough, the market is actually reversing and trending back the other way. So if you were to sell this, you would actually have lost money. So the point is, there's no indicator that is 100% perfect, but look at the number of great trades that we got going with this kind of concept during this nice downward trend. The point is, indicators are just an added, you combine them, you piece them together, you build strategies around them, and occasionally you get some nice results out of it. So the next one that we just talked about, so again, we just got done talking about RSI, which was our first one. We just talked about the moving averages. I'm going to give you one more very popular beginner indicator that we can apply to our charts, which is going to be the Bollinger Bands. Okay, so same concept as before. You can go into technicals if you're looking on TradingView. If you're looking on MetaTrader, you'll just go to the indicators feature there. But anyways, you look at the Bollinger Bands. Now, the Bollinger Bands are developed by an individual with the name Bollinger, and they are very, very simple concepts for traders to consider in their technical analysis. Now, the Bollinger Band, you can see it looks a bit fancy at first, but what it's going to do is it's basically going to just print an example of a overbought and oversold rating similar to the RSI, but instead of being an indicator window, it's going to actually have a print on this chart. So you might actually like that. This actually kind of combines the first and second indicator that we talked about. To some degree, it shows a potential overbought reading as well as a moving average that is applied into the actual chart. So the Bollinger Band, when we double click on it, we take a look at the indications here. It has a 20 period length. That's actually a 20 period simple moving average in the middle of the chart, which we're going to talk about in a second. It's applied to the close of the candle, which is pretty standard for moving averages. And then it has a standard deviation of 2. And that's exactly what these upper and lower bands, what we would call, this is the upper band and this is the lower band of the Bollinger Band. So this is the bands concept. So when we look at this band is basically, the bands here are giving you a standard deviation of what price has been usually doing. Now, what you'll notice is that it shrinks and it rises. And during a more volatile time, like for example here, you get a much wider Bollinger Band than, for example, right here, where things are very tight and not moving a whole lot. This accounts for kind of the idea behind volatility. When the market is more active, when it's more crazy, it tends to increase the band size. And when things are calm, it tends to be more gradual and, sort of a tighter band. So how is this information helpful to us as traders? Well, the idea here being, if you get a Bollinger Band during the middle portion of the band, it's not incredibly interesting. However, if you get readings that sort of print outside of the Bollinger Band, this is where things get kind of interesting. And my personal favorite approach in terms of a technical idea is looking for an example where things are breaking outside of the Bollinger Band and then looking for them to sort of correct back inside. Now, the idea here is when price is breaking outside of the Bollinger Band, it's showing us, price is moving really fast to the upside. Now, I don't necessarily take this as a sell signal by itself. I'm not necessarily just saying, oh, it's closed out, now it's time to sell. Although that might have worked out in this case, sometimes there's examples where this thing just keeps going and going and going. For me, my personal preference is looking for an example like this where you get a break outside of the Bollinger Band and then looking for a close back inside. So for example, you can see we broke outside, we trended higher for a little bit, and then we got the sell signal. We got, for at least how I approach this. Now we're looking to resume back to normal and probably trade back into the range, the standard range of the Bollinger Band. I hope that makes sense. If it doesn't, make sure to leave a comment. I'll try and address it. But my main point here is that we are looking for extensions outside and then kind of a resumption back into the move. So this is sort of a reversal concept, because now you may ask, well, where do you use this to target, where we could go? Well, the simplest for me is usually targeting the central moving average that we discussed in the beginning when we talked about Bollinger Bands. This is for me a rolling average, and it's a place where price tends to come back. You'll notice when we're underneath it, we tend to go back to it. When we're above it, we tend to eventually come back to it. It's not a 100% thing, but it tends to go back towards the central piece. And the reason that that information is useful is because then every once in a while you get, for example, here's a signal that worked out right here. You can see we closed back, we went back to this, and then we continued higher. In this case, we closed outside, closed here. This would have been a losing example. Here's one where it closed outside and then came back inside. This would be considered a winning example. So you can kind of see this is something to play around with within your technical analysis, is using the Bollinger Bands to see if that's something you like. Some people really love the Bollinger Bands. I know a couple traders, Patrick, for example, he's one of our traders inside of the A1 trading community. He loves the Bollinger Bands and he uses them all the time. So it is really just a preference thing. You find something that works for you. This has been 3 technical indicators that we find to be pretty useful for beginners to check out and to start trying out when you're trading, when you're doing your technical analysis. Thanks for watching today's video. If you enjoyed it, make sure to hit the thumbs up, subscribe if you're new, and we've got more trading videos coming along, so make sure to hit the notification bell on your way out. Have a great rest of your day.